They just wanted to delay the day of reckoning. They didn't want the politicians in the Eurozone to have to cut government spending and be honest with the people. So they made up this cock and bull theory about inflation targets of 2% just because they could justify the money printing because they were below 2%.
In today's video, Peter Schiff, founder, CEO and global strategist of Euro-Pacific Capital, gives a warning that the 2008 crisis was just the prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the US dollar.
The big news on the day, and it's not even really big news as far as I'm concerned, but the markets, they still don't get this. We got the release of the Federal Open Market Committee, FOMC, their minutes, right? This is what the governors were discussing prior to their last rate hike, right? So we know what they did, and now we get to see their private discussions that led up to that decision. And what spooked the markets was that these minutes reflected that FOMC members were more concerned about an upward surprise in inflation than they had publicly maybe admitted to. And although these deliberations are public as well, but what they had said so far, the Fed seemed more confident that inflation was coming down, that they had won. In fact, the Fed was still signaling that rates would be cut as early as next year, right? They ruled out this year, but there's not that much left of this year. They talked about cutting rates next year. And they also talked about cutting rates long before inflation goes back to 2%. They didn't just say we're going to cut rates before inflation is 2%. Powell specifically said long before. So, long time, right? And so that would mean that, okay, they're going to start cutting rates pretty soon next year, right? So they must be pretty confident that inflation is coming down, right? Otherwise, they wouldn't be cutting rates because they're telling us how bad inflation is and how important it is to get it back down to 2%. So clearly they're not going to cut rates unless they have high confidence that inflation is coming down. Well, in these minutes, what was revealed was that they're worried about an upside surprise, which they should be. I've been pointing out on this podcast that take your eyes off the rearview mirror and look at everything that's happening in the windshield. Forget about the fact that the CPI has gone down from 9 to 3. We're now going back up, right? Whether we get up to 9 or not, that is even immaterial. I think ultimately we're going above 9, but just going back up to 4 or 5, undoes much of what the Fed claims to have accomplished. But more importantly, if inflation is going to stick around longer than the Fed thought, then the Fed is going to have to reassess its idea that it can start cutting rates next year. In fact, the Fed might actually have to raise rates more than they thought. In other words, it might not be just one more rate hike. Maybe the Fed's got to go up to 6%. Maybe they got to go higher than that. This all scared the markets, which is why you saw the sell-off. The NASDAQ was down about 1%. That was the biggest decliner on the day. And, the NASDAQ has actually lost quite a bit of ground since I did a podcast a week or two ago where I questioned whether or not that bubble had popped. And, it's looking more and more like the answer to that question is yes. Because the technical picture for the NASDAQ has deteriorated since that podcast. The overall stock market, the Dow, was down about 0.5%, so not as much. Gold reacted, as you would expect, negatively to that number. Gold dropped about $10 or a little bit more. As I'm recording this podcast right now, I think we're down another buck or so or two, whatever. We're below 1900 again. We're just above 1890. So I think this is really the buy area. I think, gold gets down a little bit below 1900. That's where the support's been. A little bit above 2000 is the resistance. Most of the trading has been between about 1920, 1930, and 1970. So I think we're still in this range. And I don't believe that these minutes are going to cause a breakdown in the price of gold. The dollar rose a bit as a result of this, but bond yields continue to rise. I've been talking about this. Again, you've been watching this podcast. I've been hammering home the point that bond yields are going up, and they continue to go up. In fact, we're almost at the high point of this tightening cycle. We had a pullback in yields, but we've almost recovered that entire pullback. The 5-year Treasury is now at 4.4, just above 4.4%, right? This is right below its high. The 10-year is at 4.258. That's where it closed. And the 30-year at 4.361. These are the highs, again, for this move, or just below them since the Fed began hiking rates. And so this is a big deal. The markets haven't even, begun to price this in, because the stock market is a lot higher than it was the last time yields were this high. And one of the reasons that the stock market went up is because yields came down. That helped push the market up. But the market hasn't surrendered much of those gains, even though bonds have lost pretty much all of their gains. And they're about to make new lows, which means these bond yields are going to make new highs. Also, that means mortgage rates, which now I think are just about 7.5. I was calling for 8% mortgages before the end of the year, and I'm still relatively confident that that's going to be the case. In fact, it's not going to be 8%. I think we'll have an 8 handle, but I think the actual mortgage rate will be 8 point something. And again, that's not even the top. I pointed out that in 1981, the top was 18.5. So there is a precedent for mortgage rates of close to 20% at a time when the United States was fiscally in much better shape than it is now. I mean, rates should be higher now than they were in 1981. We have a lot less debt now than we had back then, so we were a lot more creditworthy. And, we had a greater ability to control inflation. And we ended up controlling inflation. At least we brought the rates down considerably from where they were in 1981 because the Fed had a lot more firepower than it does now. And the government wasn't in the fiscal condition that it was in. And remember, we had big tax hikes too in the 1980s. We raised Social Security taxes, significantly. The payroll tax went way up. Who's talking about raising Social Security taxes? No. I mean, they're talking about maybe raising them on the super rich, but they're not even going to get that through. So the tax hikes can't make it through Congress. Nobody wants to cut spending. So the fiscal situation that we're in is far more precarious than it was back then. So rates should be higher. And in fact, adding insult to injury today, the Atlanta Fed, right? While we got the minutes of the FOMC, we got the Atlanta Fed GDP now. And I haven't been talking about the Atlanta Fed recently, but this is really one to scratch your head. But so they upwardly revised their predictions for Q3 GDP to 5.8%. Now, of course, that's an annualized number, but still 5.8%. I can't even remember the last time we had a 5.8% quarter, right? Nobody was expecting anything like that, including me, right? All these people that are, looking for the Fed to stop hiking or start cutting or looking for even a soft landing. 5.8%, that isn't landing at all. That's the plane is still up there in the air, right? I mean, you're not landing at 5.8%. You're not even close to the runway. Now, a lot of people would think, well, if the economy is this strong, well, the Fed can't cut. In fact, the Fed has to hike. In fact, we're going to have more inflation. Speaking about gold, I know a lot of people are getting frustrated. A lot of people who own gold are looking at it, again, back below 1900. People who own the mining stocks. Yep, here we go again, another pullback in these stocks. They're not making new lows or anything. They're just right in their range. But what's frustrating is that they still haven't rallied, right? So much has happened that should have made gold rally and the gold stocks, and it hasn't. And people are really questioning whether or not they should stay in these trades because they're like, look, when are they going to go up? If they haven't gone up now, when are they going to go up? And it's a valid question to ask. And I don't know exactly when, but I'm not going to give up on the trade. I think the longer it takes for gold to react, the bigger the reaction is going to be. So I'm patient because I think my patience is going to be rewarded. I think I'm going to make more money the longer I wait. Now, obviously, there's a limit to how long I can wait. I mean, I'm 60 years old, right? I can't wait forever. But I've already waited, a long time. But I really don't think we can't go on for many more years. It's just the numbers at this point are just so astronomically big. And again, the only thing that's keeping gold from exploding is this idea that the Fed's going to succeed in bringing inflation back to 2% and a soft landing. They're not going to do either, but they have to do both. But the markets are confident that the Fed is going to pull this off. It's not going to happen. The markets are completely wrong. And so gold is priced for something that is not going to happen. And the gold stocks are priced for something that is not going to happen. Look, think about this. Let's say inflation does come back down, or we have a soft, when the economy goes into recession, inflation comes down. The Fed's going to be cutting rates, right? The budget deficits are going to be getting bigger. They're going to go back to QE. That's bullish for gold, right? Even if inflation comes down with a weak economy, that's bullish for gold. But if inflation goes up, that's bullish for gold too, as long as the Fed stops fighting it, which eventually they have to do. Because if inflation keeps going up, the economy is going to collapse because the Fed can't keep raising rates. It's like a game of chicken. At some point, the rate hikes are too much for this overly indebted economy to bear, right? We are all levered to the max, right? It can't happen. The Fed is in a no-win position. And when the Fed can't win, gold can't lose. That's the point. So if you want to bet on something that can't lose, it's got to be gold. I mean, there are no guarantees in life, right? I can't guarantee anything. But I mean, as far as the closest you're going to get, I don't see a scenario where gold doesn't go up. That doesn't mean it can't go down first. And I think if gold goes way up, the gold miners will go up even more. So I want to have a bet. I want to have a big bet on that outcome because I think the payoff is really skewed. I mean, even if somehow I've read this wrong and I lose money, I think those losses are small in comparison to how much I can make if I'm right. But that's the nature of speculation. And you just don't speculate with more than you could lose. That's how it is. Yeah, you can't put money you can't afford to lose into the mining stocks. But if you have money you can afford to lose and you're willing to risk losing it to make a lot of money, then you got to do it. I think it's the best risk reward trade for my money that's out there. That's why I got so much of my own money in it. So if you want to buy more gold and silver, call up Schiff Gold, right? And talk to the guys there. I mean, it's a great time. I think the premiums have come down now too a bit, because sometimes, you wait for gold to go up. It's hard because not only does the price of gold go up, but the premiums on the coins you want to buy go up too, right? So if you're trying to buy at the same time everybody else is buying, you end up paying a lot more. So it's a little quiet right now. It's a good time to buy, right? A lull before the storm. So try to pick up some gold and silver. Go to, at schiffgold.com. And if you want to do a more leverage bet, buy some more of these mining stocks. Call the brokers at Euro Pacific Asset Management. Look up the Euro Pacific Gold Fund, or set up one of the managed accounts. We have a gold-based managed account that Adrian Day manages for us at Euro Pacific Asset Management. All kinds of junior mining stocks. Get them while they're cheap. Get them while people are dumb enough to sell them. So any kind of weakness, and I think this is a little short-term weakness, that's when you want to be a buyer. They kept saying the worst thing that can happen to us is that prices go down, right? We can't have deflation. We can't have falling prices. That would be a disaster when that's what everybody wants. Everybody wants lower prices. That's why they have sales, right? When there's a sale, they lower the price. Nobody says, hey, let's raise prices and expects people to come rushing in. Hey, that store is raising their prices. Let's quickly go and buy. No, it's, hey, we got a 20% off sale. Got a 50% off sale. That's designed to get people to buy because they want to buy lower. They want to buy cheaper. The lower the price, the more you can afford. Falling prices are always good. It's BS. But they came up with this idea that we can't risk deflation, so we have to have a buffer. Okay, well, if we had 3 or 4 years of 1.5% inflation, that means we avoided deflation, right? We dodged that bullet. Why do we have to have even higher inflation now to make up for the fact that we didn't have deflation in the past? we don't need it. But it was all BS. They just had to come up with more excuses. Look, I will tell you the reason or where this 2% came from. I know I've mentioned it before on past podcasts, but I know I get some new listeners, so not everybody has heard the explanation. But here's where it comes from. Because obviously, Jerome Powell didn't know, because he could have given this answer, but he doesn't even know. He's the head of a central bank, and he has no idea where this 2% came from, right? Because he just says, well, we all just agreed. Like they had a big meeting. Here's what happened. New Zealand, which had very high inflation for many, many years because they were very socialist. They had a crisis. They had a fiscal crisis. They had a big economic collapse. And so they brought in a lot of free market reforms, which cut government spending. And they privatized a lot of government run businesses, right? And it was great. New Zealand went through an economic renaissance, and I invested a lot of money. I remember I was a big fan of New Zealand for many years. And one of the things that they did is they said, okay, we're gonna have a 2% inflation ceiling, a ceiling, not a target, a ceiling. Inflation needs to be below 2%. And this was the first central bank to have an official target. Everybody else talked about, price stability. Well, New Zealand actually said, we want stable prices, but we want to make sure that inflation stays below 2%. So if it ever gets to 2%, Reserve Bank of New Zealand, you got to do something. You got to keep inflation below 2%, because if it's above 2%, you failed at your job, right? So they didn't want to get to 2%. They actually wanted to stay as far away from 2% as possible. The further below 2%, the better, because that meant they didn't have to do anything, right? As the rate got close to 2%, they'd have to start tightening policy, because it was going to be too close to the ceiling, right? It's a ceiling. A ceiling means you stay below it, right? That's the whole purpose of a ceiling, to be beneath it. You don't want to be stuck to the ceiling, right? You want to be as far below it as you can, so you have some leeway, right? And if prices went down, that wouldn't have been a problem. That would have been great. Oh, great. Prices fell. Good news, right? Job well done. That's where it came from. When the ceiling became a target, again, it was only because we were below it. That's all. And in fact, I was making a lot of fun, particularly of Mario Draghi, when inflation in the Eurozone was like 1.5%. And he was saying it's not enough. We need to be close to, but under 2, right? Their target was not 2%. It was close to 2, but under 2. That's even more absurd than 2. So according to the ECB, 2 is too much, but 1.99 is perfect. That's how precise these guys were. And, which is nonsense to believe that you have that kind of precision anyway. I mean, what kind of arrogance do you have to actually believe you can fine tune the inflation rate to the point where you can get 1.99? And then to actually think that that's somehow better than 1.98, right? But Draghi was saying we need more inflation. It's not high enough. And what was I saying back then? Not only was I calling him out for his BS, I said, what is he going to do? He's trying to notch inflation up from 1.5 to 1.9, right? And they're printing all this money, doing this massive QE. They're holding interest rates at negative, all because they think the cost of living is not going up enough, that the poor Europeans are stuck with a 1.5% inflation rate when they deserve 1.99. And we're going to do all this reckless stuff to deliver a higher increase in the cost of living, because that's what people want. That's the big problem in the Eurozone. Prices aren't rising fast enough. That's the problem. That's the problem. Of all the problems they have in Europe, the one they wanted to solve was that stuff wasn't getting more expensive quicker, and they were going to solve that problem. So I kept saying, okay, what happens if you're trying to go from 1.5 to 1.9 and you overshoot? And what if you end up at 5 or 6 or 7? Then what are you going to do? Because now you're way over. You're not just under by a little bit. You're over by a mile. Why risk it? Well, you know why they risked it? Because they didn't give a damn. Because it was all BS. They just wanted to delay the day of reckoning. They didn't want the politicians in the Eurozone to have to cut government spending and be honest with the people. So they made up this cock and bull theory about inflation targets of 2%. just because they could justify the money printing because they were below 2%. And they didn't give a damn about what happened in the future because they never care about the future, except now, the future's here. And now they're dealing with inflation that's way above that 2% target.